Welcome to Street Check, the weekly podcast from Cabot Wealth Network, which has been publishing investing research, insights, and recommendations since 1970. I'm Chris Preston, Cabot's Vice President of Content and Chief Analyst of Cabot Stock of the Week.
And I'm Brad Simmerman. I'm the Chief Analyst and Managing Editor of the Cabot Wealth Daily, our daily investment advisory newsletter. This week, we are going to talk First Republic. Are we done with bank failures finally? We're going to move on from there, talk about earnings season. Is it a disappointment? Is it a good earnings season? What are we seeing? And then we're going to talk debt ceiling. Now that the Fed seems to be willing to slow down the rate hikes, is that going to be the big new driver for the market, the big macro driver? But before we do that, we're going to do one segment that we do every week. It's called Defend the Take. This week, Chris is on deck. Chris, your take today. Interest rates will not change for the rest of the year. You have 90 seconds to defend the take, and your clock starts now.
Okay, so Jerome Powell basically said as much yesterday. At first, the market went up when he started indicating that there will be a pause in interest rates and that Fed is unlikely to be hiking anymore in the near future now that inflation is coming down. But then when he was pressed in the questions by reporters asking, well, will there be cuts? He said, we're not forecasting a rapid reduction in inflation, and so it's not appropriate to cut rates. So going off of his words, that would make sense. But also just looking at previous periods where rate hikes topped. In the last time the federal fund rates hit 5.25%, which is where they are now, was in 06-07. There were no cuts for 16 months after that. No, I don't think it'll last that long. But other recent times that rates topped, 18-19, they got to 2.5%. Fed held them there for 8 months. 2001, the last time rates were higher than this, 6.5%. They were there for 8 months. We have 8 months left in the year. So history kind of tells us, I think, and Powell's own words, telling us that I think they're going to hold firm at 5.25% for the rest of the year. Whether that's good or bad for the market, I don't know. It's been a mixed bag. Those previous 3 times that they've held, twice stocks are up significantly. The other time they were down. So it really depends on other factors, but I would expect no more rate hikes or cuts this year.
All right. And you hit the post. So
Great.
That was exactly 90 seconds.
Nice. I could feel the 90 seconds coming.
It's like the sword of Damocles hanging over your head. I don't get why the market has been so quick to start pricing in rate cuts. It's like I watch every press conference with Jay Powell, and it's like he's saying they're not cutting rates. They're doing exactly what they're telling you, but the market is still pricing that in. It's been a little bit wild to me, honestly.
Yeah, and that hasn't been the history. Hiking, stop, pause, long pause, 8 months at least. Last 3 times, 8 months at least. And you would think, given how fast they've gone from basically 0 to 5.25%, a 15-year high, more than a 15-year high, that the pause is going to be a while. I'd be surprised if it's 16 months, but 8 at least. Yes, I think it'll go into early next year would be my guess.
Maybe.
So go ahead.
I think maybe the market is expecting more things to break, which I think should transition us to the first of our big 3 news headlines: failure of First Republic, third bank failure in the last month, second biggest bank failure of all time. Are we done with stuff breaking? Is this just the beginning? What are we seeing?
It's not just the beginning. At least with First Republic, that is one that people had flagged as a bank that might be next up to break. Now, at least it kind of happened in as tidy a fashion as possible, where JP Morgan and the FDIC swooped in. And so, the damage, by the time we found out that it failed, it was already bought, basically, or the time that most people found out. So that sort of stopped the bleeding right away. Granted, stocks were down first 4 days of this week, but, I think that was probably more earnings related. Speaking of which, there were a couple concerning earnings yesterday from the banks with PacWest, First Horizon, Western Alliance, Zions, regional banks. So will there be another bank fail? maybe. But I certainly don't think this is a sign this is another surge.
Yeah, it reminds me a little bit the conditions now of great financial crisis, where what happened is once you had this sort of structural bank weakness, um, investors were essentially just targeting the weakest gazelle, right? So it's like it would be speculation that okay, well, WAMU's going under. WAMU's is especially weak. They've got so much mortgage exposure. Everybody's selling it, everybody's shorting it, and it's like once that market, that sort of eye of Sauron is on you, you can't escape. So, First Republic had their issues, but they were healthy enough that they probably could have weathered the storm if not for that targeted hunting that we're seeing. And we talked about this 2 weeks ago when early regional bank earnings were making things look sort of as expected, where it's like, okay, some deposit loss, some improvement or some increases to loan loss reserves, but nothing really unexpected. But it just seems like this sort of monkey that the market can't get off its back. So if I'm a bank investor, I'm probably terrified if I'm holding one that the market sets its sights on. Um,
Right.
but if you're aggressive, there are some bargain banks out there right now.
True. Yeah, I think even some of our value investing analysts at Cabot have suggested as much in recent weeks. Yeah, I mean, I agree with you that if you hold one of those banks, you might want to trim those positions, if not sell them. But in terms of impact on the market, like when this first happened 2 months ago, when the first bank failures happened, I think that'll be pretty limited. But in terms of the Fed, that's part of why I think the Fed is going to hold to its sort of, well, they didn't vow to pause, but it's hinting at pausing. I think it'll hold to that because banks are still failing.
Yeah, yeah. And I should clarify because I failed to hit this up top. We do have a couple of analyst guests that will be signing on a little bit later. We've got Mike Cintolo and Tyler Laundon, and we'll be bringing them on later. But apologies, gentlemen, for not bringing that up right up top.
Yep.
Chris, I do think we should move on to our second news headline. There's nothing new in the banks until they're done failing, right? There's nothing new there.
Right.
And our second big news headline, earnings season, right in the middle of it. How are we looking so far?
I think it's been, it hasn't, you can't say it's been a success, FactSet. So this data is from a week ago, but the average earnings growth rate, blended earnings growth rate through a week ago, and with 53% of companies reporting was minus 3.7%. But that's not good. But minus 6.7% was expected. We've had some better than expected earnings reports. I mean, 79% have been of companies have surprised on the high side in terms of EPS, 74% revenue. That's higher. That's higher some quarters, obviously, but Apple beat this morning. People like that. The banks, the big banks. I know regional banks have failed, especially this week, but the big banks were pleasant surprises. Set sort of a nice tone during the beginning of earnings season, and you would have thought earnings season would have been the thing to send stocks back down. Stocks are almost exactly even. At least the S&P is almost exactly even since earnings season started. So I wouldn't say it's been a failure. Not a great success, but I'd say somewhere between neutral and success thus far.
Yeah, the big fear was that this earnings season would reveal that the market hadn't adequately priced in an earnings recession, that companies were going to come out and miss wildly. To some degree, we're benefiting from low expectations, right? Like the broader markets expected that there would be some weakness in earnings. But it's been all eyes on the Fed for 18 months. Other than that, the market is pretty efficiently pricing in macro conditions, it seems.
Right.
We had better than expected jobs numbers, and the market's up significantly, which we would have expected the opposite, 3 months ago, where good job numbers means the economy is too strong, which means the Fed's going to keep hiking. But Once Powell removed that language of potential higher rates, I think good news is sort of turning back into good news. Is that a?
It's yeah. It's we were talking earlier, and it's interesting when Powell was talking. First stocks were up because he hinted at a pause, but then as reporters pressed him on cuts, and he said no cuts, or said there probably won't be any cuts. Markets, stocks were down. Within then today, like you said, yeah, jobs numbers come out like way better than expected. Unemployment is lowest point since 1969, I think, 3.4%. But markets, stocks are all up more than 1%. So yeah, maybe like a little normalcy returning. But for now, that brings me to number 3.
Yeah, I know where you're going on this. Hence
Brings
the
me to number
chuckling.
3 in our big 3, and that is the looming debt ceiling. So the deadline, I believe, is for now is early next month, early June, about a month from now. They can push it back. If you go back to 2011, I did look back at 2011, which was the last time we truly threatened to default on our debt. It was fine. A deal finally came 72 hours before the deadline on July 29th, 2011. Fear didn't really set in until about 10 days before. And on July 18th, from July 18th till the time the deal was done, 11 days later, stocks were down. S&P was down 11% and kept falling even after the deal was done. Market fell for like a month, down 16.5%. So I think if we approach the deadline, which I bet we will, I think we'll get a deal. They'll get a deal done eventually. Who knows? But if we approach the deadline, I could see some panic setting in, and people. I think that'll take center stage over the Fed over the next month or so.
Yeah, Yellen came out, said that based on tax receipts and funds sent out, that it's estimated June 1st is when the federal government runs out of money. Maybe there's steps that they can take to shuffle that date around a little bit. The thing that is a little bit concerning to me is it seems as if politicians don't really want to listen to the market screaming, "Hey, raise the debt ceiling," until there's blood in the streets, right? Until it's majorly selling off. If institutions, big investors are largely still on the sideline, will those cries be nearly as loud? Is it just going to be Main Street that takes the brunt of the pain? I don't know. My hope is that if we get to that 10-day limit, that Yellen and the Fed and the Treasury are all going to say, okay, well, we're just going to do this $1 trillion coin, right? We're allowed to mint any currency worth any value. So we're going to mint a $1 trillion platinum coin, deposit it into the United States general account, and then never have to worry about the debt ceiling again. Like I would hope that somebody that is serious is willing to take a look at some of the extraordinary measures, because I really don't trust that the negotiation is going to get done effectively, given how polarized everybody is right now and has been for years.
Do you think we will default?
This would have been a hot take. Maybe we'll save this.
Save it for the next one. Your next week. Yeah.
All right. That'll give me some time to think about it.
Okay. Yeah, because that would really, the 2011 thing, this was like a month, stocks pulled back. They will pull back significantly. And that was with the deal getting done. I can't imagine if it didn't get done, what would happen.
But we're still near those October lows. It's not as if the market's been like phenomenal for the last 6 months. We've already sort of suffered a major correction coming into this environment. So maybe there's just not as much meat on the bone.
Yeah, we'll see. I hope we don't find out. But speaking of the meat on the bone, let's go to our next 2 guests. I don't even know what that means.
Good, me neither.
That's as Brad, you mentioned, Mike Cintolo, who is chief investing strategist at Cabot Wealth Network, and chief analyst of Cabot Growth Investor and Cabot Top 10 Trader, and Tyler Laundon, who is chief analyst of Cabot Small Cap Confidential and Cabot Early Opportunities. gentlemen, use that term loosely. Welcome.
What's going on, peeps? What's happening?
Welcome aboard. Can I start off, Mike? What's your recollection of the 2011, the market in 2011, around the last time we were approaching the debt ceiling?
Yeah. So believe it or not, I remember it. There was the debt ceiling. Europe was kind of having a double dip recession, and the market was kind of topping out for most of the first half. So it was kind of tenuous anyway. And then I think like the European Central Bank hiked rates, even though they should, one of these things was going on. So it was, I think it was the debt ceiling, but then I remember there was like 3 or 4 things in a row. And then the market it was like all within like 8 days, it went down, whatever it was, Chris, you said 15 or 20%. So yes. I remember it not being fun, but it was kind of all over, not over, but it was all done in like 2 weeks. And then we kind of built a bottom and got going from there. So.
Right. Tyler, do you remember much about it?
Pretty much just like Mike did. I just remember, kind of a little bit of a disaster. Just a lot of questions, wondering about what everybody is doing by dragging this thing out and taking the market, pulling the market through the mud and all of that. And so it's just kind of interesting listening to you guys a few minutes ago talk about whether that would happen again. And boy, what a stab in the back it would be if the Fed has been raising rates and basically pushing everybody into fixed income securities, and then they can't get the job done, and there's risk of default. I mean, everybody that's been buying 3-month treasuries and whatever, thinking that they're good.
God, I didn't even think about the treasury mark, the pricing markdown, and what that would do to the regional banks' balance sheets. Because they've got to mark the for sale securities to market. So if there's a default risk that reprices bonds by like 10%, that's a big hit to bank balance sheets potentially.
I refuse to believe it'll happen, but
God, I hope not. It didn't.
Yeah. Well, let's shift to more positive things. We wanted to have both you guys on. You're both growth stock investors. Tyler, your focus is more small caps and early stage opportunities. Mike, you're more general growth, and with top 10, you go. That's focuses on momentum stocks. We're 18 months into the bear market in growth stocks. Basically, I mean, the Nasdaq dipped before the S&P November 2021. Yep. Mike, I'll start with you. I mean, your market timing is sort of your area of expertise. What are you seeing now? Are things pretty neutral, or any positive signs out there? What are you seeing?
No, I think there's a lot of so they're pretty neutral, but there's a lot of positive signs. I mean, look at all the stuff you guys are just talking about the last couple of minutes, and the market's pretty much unchanged since last spring, almost a year now, May, June type thing. And some of it's narrow, big cap, Microsoft and all that, but even small and mid cap indexes, they're not falling through the floor. So I think the distribution phase from last year is probably over. You never can say for sure. And I think we're kind of trying to transition to a bull trend, but we thought we were doing that earlier this year, and the Fed said no, not yet. And now we got banks and debt limits, and I'm sure there'll be some other worry that comes up next week or whatever. But so I think there's a lot of underlying positives, but excuse me, we still see very few stocks able to get going for more than a week or 2 or 3. They gap up on earnings and then they sell off the next day, so sort of thing. So I still think the next big move will be up. I just don't know if that's going to start in a week or 2, or we have to get through the debt limit, or all this different things. So that sort of thing. So yeah, I'm cautious but flexible. That's how I'd say it.
Yeah. And Tyler, what are you seeing from small caps right now? What are you seeing from just the behavior of the stocks themselves, but also earnings?
Yeah, so kind of just piggybacking, I guess, on what Mike said, the small cap index has been pretty beaten up because of this regional banking issue. There's a pretty heavy weight of financials in like the S&P 600 small cap index. So that's been pretty painful for that, which I think is a little bit unfortunate because there are some good things going on in the asset class. But it's kind of interesting, like you look at small caps, and when there's so much uncertainty out there like there is right now, you see these stocks move around so much because in some ways, the businesses are so much more affected by like these extreme swings in what's going on in the economy. So like in terms of just some feedback from some of the recent earnings reports, like one company reports a big decline in interest in their software platform in the end of December, and the stock tanks after the Q4 earnings report. And then yesterday, they report, I'm talking about Bill.com, they report earnings, and a lot of users, that trend stopped going down. And so I think that it's almost like an echo chamber with some of these smaller companies. Not that Bill.com is a real small company, but it's still on the smaller end of things. And it's a difficult environment because what we really want with smaller companies is a nice even trend, right? And not these kind of outsized underperformers and outsized overperformers, because when you're a stock picker, that makes it hard to have a portfolio of say 15 stocks with 80% of them doing well.
Yep. And I know, Tyler, you've written some about med tech stocks recently. I know that's a sector you like. Is that your favorite sector right now in the small cap area? And B, are there others that sort of jump out?
Yeah, I think for playing like both strength in businesses and also for like momentum in terms of stock charts, medtech is a pretty good place to be. The procedure volume has been going up coming out of the pandemic, and I think a lot more people really are more focused on like health and wellness these days than maybe before the pandemic. And so there's kind of a lot of tailwinds there for some of these smaller companies. And so the ones, they're not all the same, obviously, but a lot of the ones that I'm covering in the two services have really strong procedure growth as well as pricing power. And they spent a lot of time during the pandemic, getting the word out, working with surgeons and building their sales teams and just kind of showing how their solutions are better than maybe what's offered by like a Medtronic or one of the bigger players. And so it's kind of interesting just when you get into the weeds of what's going on with some of this technology. And there's some interesting opportunities. So yeah, I feel pretty good about that. I think software is kind of a hit or miss type place. We're seeing like a company like HubSpot is kind of a consolidator. That's good for them. And we're seeing that in some other areas of technology and software as well. But it's still kind of hit or miss, I think, beyond medtech.
Right.
One thing I wanted just to follow up though is just, I sort of was just thinking about this when Tyler was talking about all the companies is, yeah, I've been going through and stock market wise, it's definitely hit or miss, but yeah, it's surprising. There's a lot of recent, when I say recent, last 2 years of IPOs, and there's just still a lot of like new, even software companies or whatever that have something new niche, new angle, medical, retail. So it's interesting to see. That's one of the reasons I'm kind of optimistic is I think there's like fresh leadership out there, new stories and new products. It's just a matter of kind of having Fidelity and T. Rowe Price pile into them. But the companies are out there. It's not just like, I mean, NVIDIA looks great, but it's not just like NVIDIA, Microsoft. When you kind of go through all the research, like in top 10, there's a million of them, every month that pop up.
Yeah.
So what's the catalyst that you're looking for, right? Distribution's over. What starts accumulation? I'm just trying to like build a narrative in my head. What's the thing that convinces these companies to get off the sidelines and gets the big investors back buying?
I wish I knew, Brad. But I think the obvious thing is, yes, I do think the Fed is kind of, I think if you're Fidelity and you're building positions, number one, it's easier to buy something that's super liquid and you're familiar with. So Apple, Microsoft, all that stuff, right? That's doing relatively well. I think they're doing due diligence and nibbling on some of these other smaller names that are a little less liquid, not illiquid, but less liquid. I just think they just don't want to feel like the rug's going to get pulled out from under them. Like not an individual stock wise, but like, hey, are we going to have negative 5% GDP in Q3? Like, I don't want to be piling in right now ahead of their earnings report, that sort of thing. So whether it's the Fed or the debt ceiling or inflation just craters, something like that. I'm not sure what it is because it's usually, I remember in 1999 in October, which at this point I'd only worked here for a few months, but I remember the market took off. This was the final run into the bubble. And it was a productivity report. It was just some random report came out and all of a sudden the futures were up like 2%. and the NASDAQ doubled in the next 6 months. I mean, I'd love for that to happen, but
Yeah.
usually it's something that's kind of random. That's just, in fact, the day of the bottom in October, not to go on a tangent, was actually a worse than expected inflation report. We gapped down and reversed, and that was the bottom of the bear market so far, at least for the indexes. So you never really know, but I'm just kind of more watching the market's action.
Yeah. Is it almost like we'll know that, the bear market is mostly over or the next rally has begun when the market is not just so conjoined with the news cycle? I mean, I guess today is a good start with stocks being up after a really good, better than expected jobs report. I mean, normal times, logically, that makes sense,
Right,
but it hasn't been the
that
way
sounds
lately.
terrible. Yeah.
Right. Yeah. I wonder if, probably won't really know it until after the fact, but is that kind of what we need to see happen?
Yeah, that's why the indicators aren't focused on the news. But yes, if it's
Yeah.
news driven, means you don't really know what's coming. Again, not to go on a tangent, I remember after the bottom in 2003, I remember there was a PMI report that was terrible. And this is right after the second Iraq war began, and the market gapped down like 1 or 2%, and just all day long, right back up, and closed up on the day, just because they weren't paying attention to the news at that point. They knew that things were going to get better, so they're buying when they could, So yeah, I think it's more going to be about, do we have a bunch of sustained breakouts, new leadership, and of course the index is actually going up as opposed to chopping, up and down every couple of days.
Tyler, what's been the most encouraging thing you've seen either from small caps or just in your sort of areas of expertise in the last, say, couple months?
I guess I'd have to say, like, broad market wise, like, I get going back to a lot of what Mike has said about like the market trends. Like, it hasn't fallen apart. It's been pretty resilient. So like when you just step back and you look at, like, if you're reading the newspaper, you pull up the Wall Street Journal, like the chart looks okay. Like, it's not scary. I think that we've been seeing stocks trade more on individual merits, which is both good and bad. But it's at least helping us kind of look in and say, under the hood of what those companies are doing, like, all right, what's going well, what's not going well, and what is a takeaway message that we can maybe apply to this other company. So I think that is encouraging because it helps us understand more business specific and market specific trends. And it's just more interesting. It creates more interesting work. It kind of, a lot of what I do is we're trying to hunt for, opportunities other people don't know about, right? So like that whole treasure hunt aspect is a lot more fun to do when you feel like the stock that you're looking at is actually getting rewarded for doing something well, rather than just getting obliterated because of a jobs report or, something that just does not seem, it's not really relevant in the grand scheme of things to where that company is going to be in 2 years.
Right. Brad, any more questions before we move on to stock picks?
No, it sounds like you guys are looking for strong stocks to maybe start pulling up sectors to then maybe start pulling the broader market forward. And based on what you were saying, Mike, about headlines, maybe post summer, right? We get the debt ceiling issue behind us. Hopefully that gets resolved without too much pain. Fed reinforces that they're no longer a monkey on the back or boogeyman or however you want to phrase it, and they say, "Nah, I think we're at terminal rates or we're near terminal rates." And then we sort of pivot to an environment where good companies get, as Tyler said, rewarded for performing well instead of just maybe not getting punished as harshly as the market. I don't know if you guys have thoughts on my narrative building there.
I'm all for it. Yeah. I just think it's, we had a bull market, we had a bear market, or we're in a bear market, however you want to look at it. And I don't know. I think the market can go up 50% or 70%. I mean, that's what we do in a bull market. So, the one thing I was going to say, I actually forgot to write it in this week's Growth Investor. There's too much other stuff to write, but everything is so obvious right now. The bank crisis is obvious. The Fed is obvious. Inflation's obvious. Like, just everything is so, selling on strength is obvious if anyone who's investing. And, it definitely feels to me like the end of a bull market, you learn to buy the dip. And then when it stops working, it takes a few months before people say, oh, wait, this isn't working, And I just feel like there's a lot of education going on right now about maybe things that aren't going to work next year, in the next year sort of thing. So we'll see how it goes. But yeah, I think there's a lot of dry tinder out there. We just need a spark.
Yeah.
Bullish dry tinder, I mean.
Right. Yeah. Well, speaking of which, let's move on to so Brad and I decided that this is the first time we're doing this, is once a month when we have guests on, we would all pick a stock that we think will perform best for the next month. A month is very arbitrary and very short amount of time, but it's content and it's something we can update, monthly. So we each picked a stock today that we think will do well for the next month. We'll start with you, Brad.
Right.
What do you got? What do you think is going to do well the next month? And I'll write all these down so we record them.
Okay. So I was looking at two stocks that have both had good, strong momentum, trading near all-time highs. And I was sort of vacillating between the two of them. And ultimately I landed on Novo Nordisk, NVO, just off 52 or just off all-time highs, gapped up on April 12th ahead of earnings, came out, reported earnings that beat expectations, but they also announced that they would have lower volumes of their weight loss drug, diabetes drug, available in the US. Stock closed and backfilled the gap up from April and found some strong support and is up now the next day. So it's got some good support volume beneath it. It's trading down to maybe towards its 25-day moving, or is 25-day moving average, and it looks to be finding support. It's also a really low beta stock, beta of 0.31. So as much as we've been talking about, like, everything's news driven, everything is news focused, low beta stock helps me avoid some of that. I'm going with NVO.
Okay, good pick. I like that pick. Mike, what do you got?
All right, I'm going to go. I probably should find something that's dipped because that's the washing machine market we've been in here. But I'm going to go with, I'm not going to go with the one I own yet, but back on my watch list is Uber. I'm going with the third time's a charm theory. We did own it. We haven't owned it twice before, but we owned it earlier this year, and then the market pulled it down. But it's kind of had it bottomed last summer, and all this stuff. Nice basing pattern, and the story is just there. They're killing. Lyft is terrible. Lyft is done. In fact, I saw that Lyft was again down on earnings today, Friday, and Uber, was flat. Whereas I remember last quarter, Lyft got killed and Uber kind of took a hit too. I think people are separating the two, and it's just huge. It's basically like a blue chip now. It's a blue chip stock, an emerging blue chip that's got huge cash flow, huge earnings. Obviously, they're the leader in ride sharing, one of the leaders in all the delivery stuff too. And so I just kind of think it can be sort of a liquid leader. It's taken off on earnings, so maybe mark my price for Uber, Chris, like next week after it pulls back. But I do, who knows about the next month, but I think if the market can hold in there, I do think it can be something of a liquid leader.
Okay. Uber, Brad's favorite company. Taxi cab Brad's favorite company.
Oh, yeah.
All right. Tyler, what do you got?
All right, I'm going to go the opposite of Mike and go with something that has pulled back recently, which I feel like this one is kind of a 50-50. It's going to be up in a week. So it reports next week. This is Duolingo, a little bit larger than I typically will go with for like small cap, confidential, market cap of 5 billion.
What's the ticker symbol? Sorry.
Yeah, DUOL.
Okay. Yep.
And it's pretty straightforward. So it's an educational software company for learning languages. They have like a gamified app. I've been using it a little bit just for fun. It's the number one selling app in Google Play and on the Apple Store, founded by two engineers. Kind of an interesting backstory, and it just kind of makes like learning a language fun and easy. You can kind of define how you want to do it, how often you want to do it, what your skill level is. Kids can use it. It's tied into some school programs. There are definitely other, there's other competing options out there, Rosetta Stone and some other stuff. But let's see, I actually have some notes on it here. They have their free offering is a kind of an advertised based offering. So that brings in 12% of revenue. 8% of their users are paying subscribers, and that brings in 74% of revenue. And there's some other like in-app purchases and some English language test revenue as well. So they're a little bit diversified, but basically it's a language learning app. They are getting into math and some other areas. The stock was looking, pretty solid after its report, Q4 report back in February. Kind of gapped up and ran for a while, made like new 12-month high, and then earlier this week, I think it was Chegg reported, another education company, and just talked about how AI is hurting their business. And I think there was some sympathy selling with Duolingo, but on the company's fourth quarter earnings call, they talked about their Duolingo Max product, which is using AI, and how they talked a lot about how they're leveraging AI in their business and how that's going to lead to higher margins and new products and all that kind of stuff. And it seems to me that AI is the type of technology that would help a business like this rather than hurt it. And with such a easy way to get onto the platform, like it's free to use, you spend 5 minutes. It's not something that subscribers and users are just going to flock away from. So anyway, that's Duolingo. I think it could be pretty good. There's an earnings report coming out next week. And again, I think, in this market, it's kind of 50-50 where it goes. But ultimately, I think it's an interesting technology. And I kind of like what management has to say.
Yeah,
Tyler.
Before we get to Chris, I used Duolingo for 2 years to just try and pick up German and a little bit of Japanese. It was pretty good. It was a solid platform. And speaking to the AI component of it, if you're gonna if you can maybe upcharge somebody by like $1.99 a month to get personalized lessons that are personalized by whatever their large language model or AI framework is, I see a huge value there. I think you're 100% right that that's a technology that integrates well with AI and profitably if they can hit the right levers.
Brad, I expect you to speak nothing but German and Japanese in our next webinar. Okay,
let's
Did it actually
Check
work?
those international. Yeah.
Right, yeah, did it work?
Ich spreche keine Deutsch.
There we go.
There you go. Now I raise the odds. It's going to be 75% chance of doing well next week.
Zwei Bier bitte.
All right, mine, I'll keep it short and sweet. I like BYD, the Chinese electric vehicle, giant leading electric vehicle maker in China. Ticker symbol on over-the-counter U.S. exchanges, BYDDY. The company is just booming since they switched to basically all electric or hybrid. Revenues tripled last year. They're really good last quarter. I think they sold more electric cars last quarter than Tesla. The stock is up 22% year to date, but it's down a little bit from its highs. It's actually trading right around its midpoint of its range this year. It was down as low as 50 in mid-March, bottomed at 50 in mid-March, was as high as 67 in early February. Right now it's at 60. So I like where it is. I like the company just overall more than just a month, but in terms of the next month, I like just it's starting to recover from its mid-March lows and plenty of upside considering that it was at 67 in early February. So BYDDY is my choice for the next month. So May 5th, we'll check in whenever our podcast in early June is closest to the June 5th date. We'll report. And you guys will probably, Mike and Tyler, you don't even have to be on it. You'll just, if you win, there'll be no reward. So flip side is if your stocks do poorly, you may never hear about it. Mike and Tyler, thanks for joining us. I wanted to tell people where they can sign up for your advisories. So we mentioned, Mike, you run Cabot Growth Investor and Cabot Top 10 Trader. Cabot Growth Investor is growth stocks advisor that Mike's been running for 2 decades now, more than 2 decades.
Let's see, I ran it 2007, so not that old.
Okay, you joined Cabot more than 2 decades ago.
Yeah,
okay.
yeah.
2007, it's our flagship investment advisory, and then Top 10 Trader, 10 of the best momentum stocks in the market every Monday. and that's the weekly thing. And then Tyler, you run Cabot Small Cap Confidential, best small cap stocks on the market. Your returns, I think during bull market, I think your average return was like over 200% pretty consistently. And then Cabot Early Opportunities, which is not just limited to small caps. It's early stage stocks and some even large cap stocks that are sort of in the early stage of recovery or new revenue stream. You can find all those on the cabotwealth.com website under premium advisories. They're some of our best advisories we have at Cabot, so I recommend subscribing to those. Also, thanks for listening to the podcast today. If you like what you've heard or seen, if you're watching on YouTube, please smash that like button. And if you're listening, please give us a 5-star rating or a nice comment. Those would help us get this thing off the ground. Brad, any closing words before we sign off till next week?
Share this with friends. That's how we grow. That's how we get to keep having cool guests like Mike and Tyler come on. So if you guys don't listen and don't tell friends about it, this goes under and it goes away. So that's a promise and a threat.
Yeah, it's
and
good.
And a plea. I'm pleading with the listeners to share with friends.
Yeah, no, let's go with threat. Okay. Well, thanks, Mike, Tyler. We will be back next Friday with the next episode of Street Check. We'll see you then.
Take it easy, boys.
Bye.
Have a good weekend, guys.